Cards are in the financial news constantly, and global cashless payment volumes are set to increase by more than 80% from 2020 to 2025, up to almost 1.9 trillion transactions. But how do payments work? What goes on behind the scenes every time we tap our cards?
So payment rails are really, at the very heart of it, just the ability to guarantee transfer of funds from one place to another. And I think it's very easy to overcomplicate them at one level.
All payment rails operate because of an instruction. So somebody's asked for something to happen. So ordinarily, if I was making a payment to you guys today, I'd basically sort of go onto my online banking and say, look, I want to make a payment, £250 to David Breer, because he's promised for years and years and years to buy me a beer, never has done. All right. And so effectively, I put that instruction in. That instruction is converted into a message that's run over the payment rails to David's bank. My bank's confirmed that they've taken £250 out of my account, so it's good for David to have my £250. He gets that into his bank account. He sees it on his statement or on his smartphone, and he then knows that he's been motivated enough to run down to the pub, order 2 pints of Adnams, and I'll see him at 5 o'clock tonight.
Payments rails are facilitators of any payment you might want to make. On the surface, it seems simple. But to enable the transfer of money, there is a complex system of back-end checks and transfers that run along the payments rails until the transaction has been cleared and settled. Essentially, when the person A has made the transfer to person B, or, in the case of a purchase transaction, the buyer has the goods and the seller has the money. The time taken to clear and settle varies depending on the rail and payment method you use, as we'll see in due course. The best version of this is real-time payments and settlements. But in the current system, that is not always possible.
And real-time money isn't a new concept. When groats were invented and when people walked around looking for gold in the streets of London, we used to swap coins around. That's real-time money because you give somebody a coin, it's settlement finality. They then own that coin. It's the same as if I was to give you a £10 note today, you then have that £10 note. And it's interesting that the friction associated with moving physical currencies is less than the friction associated in many instances of moving digital currencies today.
As Nick said, real-time transaction in the physical world happen all the time when people exchange cash. This was also the case in the past when people exchanged goats for fish, or even goats for gold coins. It was a real-time transaction. The payment was settled and the debt cleared instantly. Over time, people began trading goldsmiths' receipts in lieu of physical gold. As trade expanded, these came from a variety of different goldsmiths, often from much further afield than their local town. The goldsmiths needed to set up a network of trust in order to clear and settle the transactions.
So what they knew was that if you had a receipt that was drawn on goldsmith A and the goldsmith in a different country trusted that goldsmith, they would actually be happy to take that receipt as proof of payment. And that morphed eventually into the concept of things like bills of exchange, bills of lading. We would often know those in our daily lives as checks.
Hundreds of banks produced checkbooks on the basis that it was far easier to write one note as a promissory note than taking thousands of coins across towns and cities, particularly bearing in mind that you were looking at a period of huge industrial explosion of projects that required a lot of payments taking place to a lot of suppliers, far more than ever before. So you ended up with this supply chain, which we wouldn't have talked about in days before the Industrial Revolution, because the supply chain before would have been just the guy buying your sheep some wool and you buying food for the sheep, whereas now you're talking about building railroads and building factories. It's a very different environment. And so the check became something that enabled more and more trade with trust as a promissory note for businesses.
Promissory notes and checks made everyone's lives a lot easier and safer when they didn't need to carry physical gold. However, these checks still needed clearing and settling to ensure sellers got their money and the buyers' accounts were debited.
It used to be very complicated to process the payments and also quite costly. So check processing was originally based on a physical exchange of checks. So the banks would actually get together and exchange bags of checks, typically from the collecting bank to the issuing bank, for reconciliation.
In 1770s England, the Five Bells Tavern was one such location where bank clerks used to meet to exchange their checks. They would balance out the checks and settle the differences in cash. If Bank A owed Bank B £250 in checks, but Bank B owed Bank A £200 in checks, they would net the difference and only £50 in cash would be exchanged from A to B. This process of physical transfer took time and was also risky if the other bank was not solvent enough to pay the debt. It can still take up to 3 days to clear a cheque, even over modern payment rails. Is the time of the cheque over?
I think the use of checks is diminishing rapidly, and I think the pandemic is probably going to speed that up. If you send a cheque to somebody's office and they're not in the office for 18 months, the cheque's expired. And so I think that there's a move towards, digital payments. I mean, most businesses now will pay electronically online. So I think checks have pretty much, had their day.
Today, the majority of the money moved around the world is transferred digitally. But how does this process happen?
If you want to transfer funds between two people, you've got several actors in this party. You've got the primary actors, i.e. the people who are doing the trade. Call them A and B. Those people will probably have bank accounts. And those bank accounts will need to share some mechanism by which they can transfer the funds. So they'll probably have a bank account with someone else who almost invariably will be the central bank. So when you initiate a trade, what a payment rail will do is effectively A will use whatever mechanism, a card, a check, a faster payment, and they will effectively go to their bank, and the bank will send a message to the other bank to say, right, this person wants to initiate a trade to this account. Once that has gone through, you then have the process of clearing, and that really means about clearing the debts, okay? What has to happen in order for clearing to occur is that settlement needs to take place. Settlement is really where the money moves from Bank A's account into Bank B's account. And they do that through their shared bank account, which almost invariably is the Bank of England, or the central bank in whatever country you're in. In the Bank of England, they have, RTGS, the real-time gross settlement system. So every bank will have an RTGS account inside the Bank of England. And in order for that debt to be cleared, fully settled and cleared, it needs to have been moved on the Bank of England's books from Bank A's account into Bank B's account. And as soon as that has occurred, then that debt has been cleared.
The central bank is one of the most important players in the cycle. Alongside ensuring the banks and rails are regulated and efficient, they also hold ledgers for every bank in their country of origin. In other words, they are...
Well, they're effectively the bank's bank, which basically means banks use it to store liquidity that they hold, and banks use it to transfer liquidity that they hold to other banks. So I think it's important to know that the only place where money actually exists is at the central bank level. So wherever there's a payment from one bank to another, there's typically a transaction that happens at the central bank.
The only place money really moves is in the central bank. The process of clearing it through the central bank varies depending on which payment method and rail you use.
You typically have 3 types of payment infrastructures. You have a high-value payment infrastructure, what they call a real-time gross settlement infrastructure for high-value payment that goes straight into the central bank. And the minute you've paid, it's done. The second method that's always been there is ACH payments, and that's typically split into 2 parts. On the one hand, you have direct debits. On the other hand, you have ACH credit payments, which is typically not real time. In the UK, it takes 2 days for the money to arrive in your account. This is typically used for non-urgent payments. Most people would receive their salaries through that still. The third one is what we call real-time payment system. Those systems typically operate on a net settlement cycle. So the central bank settlement is not happening with every single payment, it's happening in bulk.
And the banks have agreed, as part of the fast payments rail, if they receive a message from another bank, to credit the other person's account in real time. So as far as the person is concerned, that debt is settled and has been cleared because it's money they can use. Actually, that hasn't been settled from a financial perspective, because what happens is that all of the banks total up all of their monies over that 2-hour period and they net out the difference. And they'll say, right, I owe Bank B this, I owe Bank C that, Bank D owes me this amount of money. And then they'll basically orchestrate that through the Bank of England, moving the appropriate amounts of money through their RTGS Bank of England accounts into the appropriate other banks. That cycle is then settled and it has been fully cleared through the Bank of England.
That system works if everyone is moving the same currency and under the same regulatory process. Clearing between different currencies is harder, as there is no central global authority who oversees everything. When you come to do international payments, it means the central banks of two countries have to be involved in the process.
For every single foreign exchange transactions, there are basically two payments involved, one in one currency, the other one in the other currency, and a lot of reconciliation, which ultimately is what makes foreign currency more complicated than single currency transactions.
At the moment, I think still quicker to take money on a plane to Australia and deliver it by hand than it is to wire it. All right, and the reason why I know that is I've done that. I've been to a conference down in Australia and we wired $20 down, and I got there and I took 20 Australian dollars with me, and the presenter at the conference hadn't received the $20, and so I gave him the $20 on the stage.
While Nick's physical $20 made its way directly to the payee, the digital $20 transaction process has no tracking. The conference presenter had no idea when it would turn up. This is a common problem in many payments processes.
The most frequently asked question in banking is, where is the money? All right, that's nuts. We should know where our customers' money is, and we should want to move that as quickly and as efficiently for them from point A to point B to satisfy their instruction on their money to their customer or client or wherever it's going to. And today that's, it's slow. The UK, for example, we don't have a fully transparent, fully operational 24/7 by 365 payment system. It doesn't exist. Yet in India, they do. India's RTGS platform went live just over a year ago, and it's 24/7 by 365. And they made a specific decision that in order to reduce financial friction in their country, to move money around quickly, the only way to do it was have real-time money. And so I think that in the UK market, we need to catch up. And I think that the technology capability to deliver that now exists. And that's what RTGS Global does. What it's doing is saying, look, we want to move $1 trillion from the Federal Reserve Bank in New York down to the Reserve Bank of Australia. Can we do that, please? Yes, we can. How long will that take? 300 milliseconds. Can we do that on a Sunday? Yes, you can.
While the technology may exist, the infrastructure and processes are not yet in place across the board. What can we expect to see more of in the future of payments?
There are a lot more micropayments. There are a lot more things that you pay for on the go, and I think that will only go up. So I know some of the car companies are working very actively and effectively turning the car into a payments device. That is a driver. You don't need to worry about paying for fuel, paying for road tolls or whatever anymore. Payments are the unpleasant part of the buying experience, so it needs to be as simple, as straightforward, and as invisible as it can be.
I think that by the end of 2022, somewhere between 25 to 50 of the major currency corridors will be operating atomic tech settlement systems to facilitate customer service. They're not doing it for any other reason, because if you don't facilitate customer service improvements, there's no value in the change. There is zero reason why it should be slow.